Hi, my name is Adam Whitmer and I'm your host here at ComplianceCohort.com. This compliance clip is going to talk about deposit statement delivery requirements. So specifically, when are periodic statements required to be delivered? So Regulation DD provides us with a number of requirements if we deliver a periodic statement, but there's a different regulation that requires when we must provide the periodic statement on deposit accounts. And do you know what that regulation is? Like we're in the room and I'm asking you, right? Of course, it's Regulation E. Regulation is the rule that actually requires the delivery of statements for deposit accounts. So that is the rule. Now, the actual citation is found under 1005.9B of Regulation E. And what this states is that for an account to or from which electronic funds transfers can be made, a financial institution shall send a periodic statement for each monthly cycle in which an electronic funds transfer has occurred. So there's a lot there, and I've bolded a couple of things because this is important to understand. It says, for an account to or from which electronic funds transfers can be made. So if you have an account where a funds transfer could be made but isn't necessarily being made, they must at least receive a statement, the rule goes on to say, quarterly. If it does occur in the monthly cycle, they have to receive it monthly. So the reason I bring up these bold pieces in this rule in 1005.9b is I have seen in auditing financial institutions where certain banks specifically have not complied with this rule in Regulation E, because they thought that they didn't have to send periodic statements. For example, I was in a bank that did not believe they had to send periodic statements on their money market accounts. Well, their money market accounts had some senior citizens receiving Social Security deposits into the account, and there were some ACH transactions going out of the account. That means the accounts could have to or from electronic funds transfers, right? To or from the account. It could occur. It doesn't have to. Now, it's my understanding some systems allow you to shut off electronic funds transfers to or from the account as a hard code, and some of you may have done that for some of your accounts. But if you've not done that and the possibility is there, you are required to send statements at least quarterly and monthly if an EFT occurs during that cycle. Makes sense? All right, moving on, Adam, right? So there are some exceptions to this rule, and one of those is passbook savings, which is probably what some of you brought up. So the exceptions are found in 1005.9c. And of course, the first exception here is for passbook accounts. They specifically do not require a statement under a couple of conditions. The first condition is if the financial institution updates the passbook upon presentation, or the second option would be if they enter on a separate document the amount and date of each electronic funds transfer since the passbook was last presented. So passbook accounts don't need statements if you are still using passbooks and still updating them as required under 1005.9c. The next exception is not actually found in 1005.9c. It's found in comment 3 to 1005.9b in the commentary, but it talks about inactive accounts, and it says inactive accounts do not require a statement if it's inactive based on your bank's definition of inactive. Now, I will tell you that most financial institutions, banks specifically, send the notices anyway, send the statements anyway, because the fee more than covers the cost of sending the statement. So that is an exception. Also, they talk about how other accounts must receive a statement at least quarterly. There's a little bit more information on deposit statement delivery. It's found in the commentary, and it's the commentary to 1005.9b. They talk about periodic cycles. So, what is a cycle? Well, a cycle may be shorter than monthly. That is permitted. Typically, it's going to be monthly, but it could be shorter. But it should not vary more than 4 days from the regular cycle. Now, there is an exception to this where it says in the commentary that cycles can be shorter if the financial institution is changing cycles for operations or other reasons. For example, if you're moving all of your statements to the 1st of the month or the 15th of the month to batch them out, then you could have one cycle that is shorter because it's for operational reasons. That's permitted. The commentary also has information on interim statements, which I thought was a good idea to share with you because the rules in Regulation E and DD both talk about interim statements, and all they mean by interim statements really are the monthly statements. The regular statement requirement is quarterly, but the interim statement is the monthly statement that's required if an EFT is provided. So that is the interim statements, and if you provide an interim statement and it contains interest or rate information, you must also comply with the rules found in Regulation DD. Whew, that was a mouthful, wasn't it? So that's all I have for you today on this compliance clip. Again, my name is Adam Whitmer. I hope you enjoyed this topic, and thanks for watching. Have a great day.